In private property law, a covenant is used as a contract to limit the use of an object, such as the prohibition against expanding a building or changing the color of a structure's facade. Given that Bitcoin is a form of private property, the term covenant seems to be the ideal way to describe limitations on transactional activity. Although the land is yours, there may be restrictions on what you may do with it. In today's video, we will be learning about the Bitcoin covenant in simple terms. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, forex, and many more. So watch this video till the end and hit the subscribe button. And click on the bell icon to get notifications for our future videos. So let's begin the video. Bitcoin covenant proposals specifically limit where and how coins can be transferred after being purchased. These limitations are comparable to those that banks may impose on particular merchants who they suspect of engaged in illegal activity. Covenants are a useful way to improve Bitcoin, but they haven't been actively studied for a while because they are difficult to implement and raise questions about the currency's fungibility and resistance to censorship. Can Bitcoin be improved? Undoubtedly, Bitcoin can be made better, and BIPs, including covenants, offer suggested revisions to the consensus model. Covenants are a part of Bitcoin improvement proposals, BIPs, the process of upgrading and improving Bitcoin in order to address problems with scalability, security, and usability. With the help of covenants, a Bitcoin script language can stop a legitimate spender from using their funds on particular other scripts. They explain how to enhance Bitcoin using smart contracts, which are pieces of code that run when specific criteria are met. These Bitcoin contracts can help scale the network while preventing the theft of users' money in the event of an attack. Numerous potential uses for covenants include trust-minimized loans, congestion control, scaling the number of Bitcoin transactions per second, and more. These use cases are outlined in the contentious BIP 119, which was proposed as a soft fork by developer Jeremy Rubin and is currently being reviewed by the community. This Bitcoin improvement proposal intends to adopt a new operation code and introduces a change to the Bitcoin code, opcode. A small number of valuable use cases are enabled by the opcode check template verify CTV-style covenant without posing a major risk. Congestion-controlled transactions, or CTV, have the potential to aid in scaling Bitcoin. Fees rise rapidly when there is a lot of transaction activity. Large payment processors can consolidate all of their payments into a single transaction using this CTV, conserving block space and enabling quicker and more affordable execution. How do Bitcoin covenants work? Covenants, which expand the Bitcoin script language and enable transactions to constrain the scripts of the redeeming ones, can be seen of as the lowest and most basic unit of processing available to a programmer. A locking script protects your Bitcoin in a standard Bitcoin transaction, and in order to spend the coins, certain requirements must be satisfied. If you don't have a signature confirming you have the private key that matches the public key, you won't be allowed to spend money. Another example of a locking condition is a time lock, which functions similarly to a covenant and prevents spending of coins until after a specified amount of blocks. In a covenant, we take a step further by limiting what you may do with that coin or where a coin can be spent. In a regular Bitcoin script, we merely require specified conditions to be met to unlock a particular requirement. Sign a transaction with a private key, for example. A Bitcoin covenant, which includes a set of restrictions on an unspent transaction output, UTXO, which specifies how the transaction's relevant coins can be spent, is sometimes described as a tool to establish rules on how the control of coins will be passed in the future. For example, one wallet has the ability to safeguard the Bitcoin it possesses by adding a few connected addresses to a whitelist. This wallet can only distribute the same Bitcoin to addresses that are listed on the whitelist when broadcasting a Bitcoin transaction to another wallet. Advantages of Bitcoin covenants. One of the most important advancements that developers are continuously seeking is strengthening Bitcoin security, and covenants may be able to help greatly. Covenants aid in security as well as increase scalability, particularly in the face of the $5 wrench attack. An ideal use case is taking steps to secure your Bitcoin assets so that they are more difficult to steal. Covenants also allow you to restrict your UTXO's ability to be transferred to multi-sig addresses, for example, after a year. This is a good security measure. One of the greatest issues with Bitcoin security can be solved by building secure vaults and using covenants to address the challenge of managing safe keys. Vaults improve end-user security by making monetary theft less desirable. Even if the private keys used to secure the cash are stolen, the user applies a technique that prohibits an attacker from acquiring complete control over the funds. To impose a time lock on funds, this approach uses pre-signed transactions with key deletion. In Bitcoin NG, a Byzantine fault-tolerant blockchain protocol that has recently been proposed to increase Bitcoin's throughput, latency, and general scalability, covenants can also be used to construct a restricting mechanism to thwart double-spending attacks. This method is embodied in poison transactions, which can be gradually added as an overlay to the Bitcoin network. Drawbacks of Bitcoin covenants. Various prominent Bitcoin experts, including Adam Back, Jimmy Song, and Andreas Antonopoulos, have expressed some worries about the introduction of restrictive covenants, particularly with the BIP 119. Concerns about recursive covenants that the new version might include, which might deteriorate the network, have been raised by Antonopoulos in particular. When a programmer restricts one transaction, but does so in a way that restricts a subsequent transaction as well, the result is a cascade of restrictions that can never end. This is known as a recursive covenant. Blacklisting and risks of censorship and confiscation. While restricting where a Bitcoin can be spent is a benefit to increase security, it also creates a foundation for censorship and government control, which would undermine Bitcoin's ability to exist. Authorities might order withdrawals from only those covenants that have some influence over the coin. Could the implementation of covenants facilitate malicious purposes, where it would be easier for governments to enforce a sort of on-chain KYC? While this risk already exists because governments can request that exchanges send only to addresses with a taproot spend path or multi-sig control by them. Fungibility threats. Covenants may affect a Bitcoin's fungibility, or its capacity to be similar in quality and function from one Bitcoin to the next. Covenants, while helpful for security and scalability, would alter the characteristics of certain Bitcoin units, thereby resulting in different sorts of digital currency that were unique based on what could be purchased or sent. Therefore, those opposed to the proposal contended that restricting how you can use your Bitcoin will, in the end, restrict Bitcoin's utility as a digital currency, with obvious consequences for its value. There are strong views on the benefits and drawbacks of covenants, but discussions are constructive and essential to enhancing a decentralized and leaderless network. Users and node operators will ultimately make the final selection by downloading the software that best matches their preferences.
Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.